Is it better to invest from a bank account or from your private banking system, the policy? See, with the policy, you don't have to decide whether it's this or that, because it is this and that. You're going to earn in the policy and you're going to earn from the fund. So we're going to basically combine those. So the impact of changing where your money goes first makes a huge difference.
We lend to our strategic partners on land, lot, dirt. It's simple. But if you go the normal route, guess who wins? The bank. And so we do things different.
What's going on, everybody? Welcome back to the Wealth Webinar of another one for 2025, and what a week it has been. But today is going to be an epic day here at Wealth Webinar, because what we're going to do is we're literally going to go down the path of investing, okay? But we're going to do something we've talked about a lot, but never really shown the mathematics behind. And that's what we're doing with Wealth Webinar. So all Wealth Webinars this year have a lot of thought. Unlike prior years, not that they were bad, but what we're doing is being very intentional on covering things that all relate to your finances, your wealth, and you becoming your own bank by taking back control of your money. But we're really trying to get down and show you true form how this system will change your financial life. Now, think about it this way. If you had $1 to invest, would you want that dollar to be invested once where it makes money one time, or would you want that dollar to be invested in two places where it can make money twice? I know that sounds weird, but literally what we're going to show you today, we're going to show you the mathematics behind having your dollars work twice for you. They're going to be able to earn uninterrupted compounding interest. Well, on top of that, make a return. And I invited my friend Brandon on. Now, Brandon runs a fund, okay, and we're going to get into that in just a second. And it's a fund that I recently just took an investment in, and I'm also doing future investments, which we're going to show. I'm going to show you literally how one of the investments I'm going to do are going to be done. Now, I'm going to use a different dollar amount on here because I want to show you one of my, so you're going to see one of my old policies, not real old. I started it in 2020. It is designed the same way you've seen us design so many. And I'm going to show you how using the money from my policy to invest in Brandon's fund, and then taking the interest from that Brandon's fund pays me and recycling and recapturing it back into the policy. We're going to show you the math on that. But then we're going to do a side-by-side comparison and show you, here's somebody that's going to invest in Brandon's fund, but they're going to do it from a checking or it's actually a savings account. And what we did is we went in and we looked up the average return, the average interest that savings accounts have paid over the 10 years. And we're going to basically say, okay, you got money in the savings account, you invest in the fund, you take the interest from the fund and you put it back in the savings account, earning the average, the 10-year average on savings accounts. Fair enough? So it's a side-by-side comparison. And what we're going to be asking, and I'll ask all of you this right now, what do you think would be the better way to do it? Put money in this stupid, specially designed whole life, take a loan from the whole life and make the investment, take the interest from the investment, put it back into the policy as a loan repayment. So the way I said that, if any of you are seeing this for the first time, you're probably like, no freaking way would I do that. Or just do it the way you normally do it. You got money in a bank account, earning interest. You're going to take the money out of the bank account, make the investment, take the interest from the investment, put it back in the bank account. Which one do you think has the best returns? Like, which one do you think you're going to make the most amount in? Now, a lot of you are probably been around the campfire for a little bit. So a lot of you are probably saying, oh, well, definitely the policy. But there's got to be some folks on here who are new here for the first time. So let's find out. How many of you are here for the very first time on Wealth Webinar? Put I in the chat. All right, look at this. We got Robert Reed. We got, I don't know how to say that, but EWA. How would you say that? Stephen, what would you say that is?
Eva.
Okay, all right. We got Robert here for the first time. We got Caleb. What's going on? We got, oh, they're coming in fast. We got David. We got Janet. How are you, Janet? Benita's here for the first time. LB's here. We got Melissa. Wow, look at this. Alexander. We got Vicky. We got Teresa. I don't want to miss anybody. I keep going. Joe, Cheryl, Dedrick, Darla, Joanne. Holy smokes. Christy. Is there, how about, I should have asked the question. Is there anyone that has been on this before? So anyway, thank you all for being here for the first time. This show, this webinar that we do has been being done now for, gosh, I don't even know how many consecutive years we've done this. 7, 7, 8 years, and we've never missed one. It's every Wednesday at 1 o'clock. So make sure you join us. And all we talk about is how to take back control of your money by you becoming your own bank. But we do it showing many different scenarios. And today's scenario is going to be a really fun one because it's very personal to me, because you're going to use my exact examples. You're going to use my policy, okay? And then we're also going to use an investment that I actually already invested in. And I'm going to talk to you a little bit about some of the due diligence I did. So these are just some of the materials. This is the Reg A Tier 2 offering, and then the audited independent auditors report. But here's the thing I want to start with, and Brandon, this is where I'm going to let you kind of come in. How many of you on here right now know what a fund is or a Reg D fund? How many of you know what a Reg A fund is? Put yes in the chat. Okay, we do have a couple. So Robert knows Reg A's. Okay, he says no idea. All right, so it's kind of a mixed bag. Some say yes, some say no. So listen, like when I was in Wall Street, when I was a financial advisor, you know, how they taught us is they would teach us the difference between open-end funds and closed-end funds. So when you think about an open-end versus closed-end, I just pulled up this because I don't know the actual definition. And it said an open-end mutual fund issues new shares whenever an investor chooses to buy into it and repurchases them when you want to sell them. Okay, a closed-end fund issues shares one time. Now that is critical to know. So when we're going to get into this entire training today, I want to have Brandon explain the difference between a Reg A fund, which is what we're going to be referring to, and a Reg D fund. Because I got to tell you, like, if even as a financial advisor, I was told that, I would have said, you mean open-end or closed-end fund? Like, I didn't know the Reg A's and Reg D's. And the reason for that is, as an advisor, we were not allowed to talk about them. Now, this is kind of controversial, and I got to be careful how I say this, but the reason I would guess we were not allowed to talk about these private Reg A or Reg D funds is because our brokerage, our firm that we worked for, could not be paid from them. Kind of a novel thought to think about that. So just because we couldn't get paid on these, how many of you think that makes them a bad investment? An investment that your advisor should not talk to you about, or at least acknowledge the differences if you were to ask them about it. See, most advisors, here's what we were taught. We were literally taught anything that we didn't offer, we would tell the client, oh, wow, that involves a lot of risk. I'm happy to review it, happy to look at it. But usually the outcome was, oh, that's really risky. You might want to just consider funds like Vanguard or Fidelity or T. Rowe Price or some of those. We literally always stayed away from any of these. I had a lot of clients come to me about, you know, hey, I got this great investment, it pays this return, and I'd look at it and I'd be like, oh, this is really risky. Not even really knowing whether it was or was not, but because I did not have the knowledge, because I could not sell it or advise on it and get paid on it, I wasn't allowed to talk about it. This is real, folks, and I want you all to understand that just because you don't know about something, just because your financial advisor hasn't mentioned it to you, does not mean it's a bad investment. It just simply means somebody can't get paid on it in most cases, or they just don't know what they don't know. So we're going to really unpack that. One last story. So how I kind of came about this is I have a friend, Greg Hurling. Many of you know him. He's been on the show many times. Well, Greg was always really successful. I saw him speak at many events, and he had a company called Horizon Trust. Well, I was asking Greg about some of the things he was investing in, and he started talking about funds. And I'm like, oh, great. What kind of funds? Thinking, you know, I was an advisor, so thinking he was going to mention it. And he starts telling me private funds. And he told me the returns, and I'm like, wait, you're making how much? Like, is that risky? Blah, blah, blah. He kind of goes through the whole thing. He says, no, the fund raises money. It lends on real estate deals in a first lien position, and then the interest comes back, and then we just get a percentage of the interest. And I'm like, wow, what a novel idea. So the very first time I invested in a fund was through Greg. He had a fund. But then that steamrolled when I left the advisory world in 2018 to pursue the show on HGTV that me and my wife did called Risky Builders. At that point, Greg came to me and he said, hey, I'm doing a new fund. It's called CapWest, and we would love to have you on as a partner in the fund, a member in the fund. That way you can start talking to people about this. So this was an interesting dynamic because at that time, I wasn't ever talking about it because I couldn't. I wasn't a member. But now I was a member of the fund, and I started telling my other folks, clients of mine that I could talk to from the prior life as an advisor, and that's where it all began. But today, for many of you, your education, your knowledge about this is going to begin today. And I've done a bunch of due diligence. on this, but that does not mean just because I've done due diligence that it's a good investment for you. So I want to be very clear. I'm not making any recommendations. I'm not giving any investment advice. What Brandon talks about is more educational in nature than anything else. Yes, I invested in it. I did my due diligence, but if you are going to invest, please, please, please do your due diligence, consult with your professionals in your side of the court, make sure it fits your needs and goals as an investor. And if it checks all those boxes, giddy up and go. But today we're going to unpack this, and I'm going to turn it over to Brandon to talk a little bit about Rockstar Capital Group. Brandon.
Thank you, Chris. Appreciate you having me on as always. All right, Reg D versus Reg A. When I first got to the level of where it made sense to open a Reg D fund was when I was raising capital for my strategic partners in the Southeast, and we were just doing private individual notes. So I acted as more of a consultant. It became a huge pipeline of transactions. It became kind of intensive to manage it and track it. And everybody had different start dates and maturity dates and, different payments. It was just kind of wild and crazy. And in talking with an attorney, they recommended that I do a Reg D fund. So that was my entrance into basically pooling money into a fund or syndication that would allow us to more easily control and manage all the investors and all the investments and what we were lending on. So I wanted to kind of set the tone for how I got to learn about a Reg D. Now, when it comes to Reg Ds, there are a 506C and a 506B, and I'll talk about the 506C first. A 506C is always for accredited investors only. It's an exemption from registering with the SEC. So that's something to consider, right? There's less compliance, there's less regulation. Basically it's like opening an LLC or opening a company. Anybody can fill out the paperwork and submit it, and pay the fees, can basically set up a Reg D fund. Nothing wrong with that. That's just part of what Chris wants to really get across is how you do your due diligence and understanding how these things start. And let's see, I'll go to this, I'm going to pull this over here. A 506C can perform general solicitation and advertising. Because they're dealing with accredited investors only, they can market. They can market on Facebook. They can market, in commercials. They can send out email blasting campaigns. So that's one of the reasons a lot of the syndicators go with the 506C is they want to reach out to a wide network. There's no limitations on how much capital can be raised. However, typically in a 506C, it has a start point and an end point. So they're, like Chris mentioned, they're opening a fund with a targeted X amount of dollars that they're going to reach, and it becomes a closed end. Now they could set that amount whatever they want it to be. And then once they reach that, they're technically supposed to close it down. And then it's a closed-end fund. An accredited investor through a 506C will have to submit a third-party letter of accreditation. And that can be done a few different ways. As an investor, if you believe you're accredited, I'll talk about that in a minute, you can have your CPA, your financial advisor, or tax accountant or tax specialist draft a third-party letter of accreditation to submit to the fund. There's also a site called investorverify.com. And for about $59, you can go on investorverify.com and get your letter of accreditation. Now, those letter of accreditations are only good for about 6 months. So just something to think about. 506Cs are not subject to blue sky laws for the state, meaning that they can set it up and they don't have to report individually to every state that an investor is in. All right. So a little bit less regulation. It's considered an exemption from the SEC. So they're exempt from registering securities and just less compliance. It's a great way to open and start a fund. A lot of real estate professionals or people that are raising capital for, new business ventures, any type of investment really, typically will go to a 506C, going for accredited investors only, which just kind of takes out a little bit of the risk on their side, since investors that are coming in have to prove that they're accredited.
And Brandon, let me just add one thing. So if any of you are in Private Money Club right now, you probably have noticed or will soon notice that it asks you, are you an accredited investor or non-accredited? The reason for that is in the future, in order to see accredited investor deals like Reg Ds, you would have to be an accredited investor. So just a small little fun fact.
Right. And then on this slide, I had an error. This should be a 506B. So my apologies. I put this together yesterday, and I'm not real good at putting these things together, but we'll talk about this one. So same thing. This is still an exemption from registering with the SEC. The difference of a 506B is that you can accept accredited and non-accredited sophisticated investors. And a non-accredited sophisticated investor typically just does not meet the criteria of an accredited, and I'll get into what those statuses are in just a few minutes. But a 506B is typically set up when a fund operator or syndicator knows their base of investors. They have someone they've worked with. They have a list that they work with. They cannot, publicly advertise or solicit for new investors. The investors can self-accredit, which means they just fill out a questionnaire and fill out a subscription, and it is on the investors, to have integrity when they're filling out their information. And there is, again, unlimited capital raising opportunity, but typically a fund is a 506B or C is set for an amount. And once they reach it, then they close the fund, closed in, like as Chris mentioned. They do not have to file the state blue sky filings, just like the 506C. And let's see, I think I covered all. Oh, the GP and the LPs must have a relationship, especially for the non-accredited sophisticated investors, meaning that you had to have done some business with them outside of the fund. And that's why I set up my first one. All of my investors have been long-term loyal investors. I've helped them for many years, invest in real estate all over the country. So I knew my investors. And we did have a cap. In a 506B, they're only allowed to have 35 non-accredited sophisticated investors. And we'll talk about that in just a minute. For accredited investor qualifications, it is one of these three things, not all three, just one of the three. Either one, you have $1 million net worth, which does not include your primary residence, and that would be equity in your home, actually. Or as an individual, you earn $200,000 a year in income and expect to reasonably earn that for the next 2 to 3 years when you're filling out as an accredited. Or if you're a married couple, you can earn $300,000 a year. And it's any one of these three things that would make you an accredited investor. And of course, you have to have that verified with your CPA, tax attorney, or attorney or tax specialist or whatever. We're going to Investor Verify. Non-accredited sophisticated limits. So for an accredited investor, they can invest however much they want to invest comfortably in any fund or syndication of their choosing. So there's no cap on how much they can invest. But when it comes to a non-accredited sophisticated investor, there are limits. And under a crowdfunding type capital raise, the non-accredited investor can only invest up to 5% of their lower either annual income or net worth if either is below $107,000. For a non-accredited investor investing in like with our Reg A offering, they can invest up to 10% of their lower of their annual income or net worth if both are above $107,000, but not more than $107,000 in a total investment in a 12-month period. So they can only invest X amount annually, and they have to, again, fill out the self-accredit questionnaire and make sure that they're qualifying. We can always get our CPAs or our attorneys involved. That's one thing I recommend is when you're investing as a non-accredited sophisticated investor, just make sure that you're meeting the criteria and you're understanding these things, and get your CPA or accountant or attorney involved just to make sure that you're staying compliant. Let's see, under the Reg A offering, just as I mentioned there, non-accredited investors can invest up to 10% of their net worth or annual income per offering, whichever is greater. So it's per offering. So they can invest in multiple Reg A offerings, but and there's a little bit of gray line, and Chris understands this. Whenever you're dealing in anything with state SEC regulations, the way stuff is written, sometimes you want to make sure that you get your attorney involved so that you are following all the guidelines. because everybody has a different way of perceiving how they read things. All right. So let's talk a little bit about Reg A. So a recap on a Reg D fund. That can be a general partner. It can be a syndicator that opens a fund. It's typically used for one specific investment type project. And that is normally how all Reg Ds get opened. They may have, somebody may be a multifamily syndicator and have multiple different projects, and they'll typically open a Reg D for each one of those individual real estate projects. And then when it comes to like what a Reg A offering is, and I'll explain real quick why I went to a Reg A, which just gives a little bit of a basis on this. So our first fund, we raised $10 million and did that inside of a year. And we were buying real estate assets and then holding those and building and developing on those. And then also started to land bank, where we were grabbing ground that we knew that we would work on either building out later or getting it ready and selling it off to some of the biggest builders in the country. And we only had about 12 non-accredited sophisticated investors in that first fund. But the operations that I was funding were growing exponentially. And we got to a point where, in talking with the attorney, we needed to open up a 506C and go for accredited investors. And we made that minimum, I believe, a $50,000 minimum at, the recommendation of our attorney. And we could raise, as many investors as we want, but we could not have any non-accredited investors in there at all. Well, what happened is our operations were so successful and we were consistently paying out quarterly interest that a lot of our accredited investors wanted to be able to have their friends or family or coworkers come in, but the concern was that they were not accredited, which led me to open another Reg D 506B fund so that I could bring in referrals of those accredited investors, which were more non-accredited. What was funny is we set that one for a $10 million limit. And before we even hit 3.5 million, I had already hit 35 non-accredited investors. So that immediately put us in a position where we could have no more non-accredited investor referrals. And the only thing we could do for the rest of the money was raise, under accredited investors. We still had a lot of referrals coming in, quickly became something that a lot of people were intrigued by. I'd set low limits of just $10,000 minimum to get invested, $1,000 shares. I made it really easy for the average blue collar worker, what I call the blue jeans investors, which is a lot of what our investors are. And which is kind of how I grew up as well. But I wanted to make it easy, and we became, talked about. And by the way, all of our investors are all from referrals or all from relationships like this. So anyway, I opened up the fourth one. And then what happened is, people that start to have multiple Reg D offerings or funds, they call them funds. They technically call Reg A offerings. That's what the SEC makes us say. You can call a Reg D a fund. If you ever hear anybody talking about it, it's just an oddity, but it is what it is. But they set up all these things, and you've got to have software, and you've got to have a system, and everything has its own QuickBooks and checking, and it becomes pretty labor intensive to manage, or you have to really start scaling up your staff to be able to handle all of the different funds. And in talking with my attorney, I says, this is kind of getting out of hand. It's one of the reasons I went to Reg D to begin with, because I was managing all these private investment notes and mortgages and tracking. And I said that it became difficult to manage, labor intensive, and just drove our cost up. And he goes, well, Rockstar, he goes, you need a Reg A offering. And at first I'm like, what's a Reg A? Is that, and the way he said it so fast, I thought he was talking about the music, from the Bahamas. But he goes, what you need is a Reg A offering. He goes, you can raise up to, like on this slide here, if you go a tier 1, you can raise up to $20 million each year or in a 12-month period. And at the end of every 12 months, you can raise up to another $20 million. And that meant I wouldn't have to start multiple funds. I wouldn't have to start any more funds. Now, where we were, we had to go with a tier 2 because the growth of our strategic partners is, phenomenal in what they're doing. And they're now at about a $1.5 billion pipeline of ground in their operation. And they use us as their private money club, so to speak. and private money lender to help them launch all their expansion and go into new territories and facilitate getting their ground ready. So we chose the tier 2 option. Then he also said, you can have as many non-accredited investors as you want. And I'm like, well, that simplifies things. We can advertise or solicit publicly, should we need to do that. I haven't done it yet, but having that option is nice. Of course, you have to watch the language and everything has to be approved so that you're advertising properly. And all investors can self-accredit, on a questionnaire and subscription. So to me, it was a hell of a lot easier. We didn't have to get letters of accreditation. We didn't have to worry about how many, non-accredited, sophisticated investors we had. We did not have to have a relationship with the non-accredited investor. And that's pretty important because in a Reg D 506B, you have to have a relationship. So if someone is referred to you, you have to do some sort of business with them outside of the Reg D first, so that they can then come into the Reg D offering or fund, excuse me. And which is fine. I would just do a private investment note, that established relationship, and then we would, either merge that note into our fund, or when it closed out, then they would just take their proceeds and their investment and they would come into the fund. Now, so the Reg A made sense for us and it simplified our operation. We ended up merging, which you can do this, we merged all of the assets, notes, mortgages, loans, and things that we had done under all 4 of the previous funds into the Reg A. And now we have one operation. We have one, software system. We have QuickBooks for this one entity. It streamlined our operations, reduced overhead and cost, which then allowed us in our position to reduce management fees and improve what we call profit sharing or upside interest back to our investors, which I won't talk about. Everybody can set their own terms in Reg D offerings. Typically what you'll see is kind of like an 80-20 rule, where about 20% of the revenues that are generated go back to the GP, and around 80% goes to the LPs, which is limited partners, AKA investors in those funds. And it can vary. It all depends on how their structure is and, what their offer is. But a lot of the times in those real estate deals, you may not see getting paid until, 2 or 3 years down the road, just because it's value adds or new construction. You got to wait till they actually start generating revenue. All right. So that pretty much covers why we went the Reg A. That's what a Reg A is. One thing I like about the Reg A offering is there is more compliance, and we have to send up our financials every 6 months to the SEC. We also, like Chris mentioned in the beginning when he did his due diligence, we have to submit an annual third-party CPA audit to the SEC. Let's get recorded on what they call their Edgar site. Anybody can view this. We also have to submit blue sky filings in every investor state. And currently, I'm pretty sure we have investors in 46 of the states right now. We must be qualified by the SEC, meaning they've done background checks, and they've done their due diligence and homework on us. And we can be marketed. We can actually be marketed through FINRA and through a broker-dealer network. We do have the ability to compensate brokers under a Reg A. There just has to be an advisory agreement. It has to be laid out in the beginning. I haven't felt the need to do that. I personally like working with all of my investors and knowing who all my investors are. And so far, I've been in the industry for, real estate investment arena for over 20 years. Absolutely every bit of our business has been referrals. And I like that. Just creates more of a friendship and family type environment in my eyes. So yeah, there are some of the difference of Reg A and Reg D. And for us, it made sense to go with the Reg A. And what I would say from an investor standpoint, if you're looking at Reg D offerings or Reg A offerings, just know that there's a heck of a lot more compliance and qualifying and people having to follow the guidelines with a Reg A offering. And not that those that have Reg Ds don't, but they're not required to do third-party audits. They're not required to send up their financials. They're not required to, register it in every state, and they don't have to go through background checks. So that's really important when you are doing your homework or due diligence on investing in any investment opportunity, that you just understand some of those differences. That's a lot of information at once. I'll kind of leave it at that and maybe open it for questions. I'm going to back out of my whole screen so I can see chat, and then I'll let Chris kind of pipe in here.
The interesting thing is while you were doing that, Brandon, I had asked everybody a question, and that question was, what is your biggest challenge when it comes to understanding investments like this? We just went over a bunch of kind of stuff that some of you that were listening, I know your eyes were rolling back, you were falling asleep, because like most of you are like, great info, but I don't care about this stuff. But it's very important you understand this stuff. But it's just, most of you are like, all right, well, what's the return? You got the minimum. So all of you are like, okay, 10,000 minimum. It's a Reg A, which means if I'm a non-accredited investor, I can invest in this. So you're kind of getting excited. And you're like, what's in it for me? What's my return? How does this fund work? What's it investing in? All that stuff. But when I asked that question, people mostly, and it was kind of not what I was expecting, I'm not going to lie. It was kind of a mix of A and C, which A was access, which is critical. When we were talking, I was talking about access because the monies that I invested in the first round with you was monies that I've pledged from our foundation. So that was a huge thing, so that's access. A lot of people will shy away from these kind of investments because they think, oh, I'm going to tie my money up for a long period of time and I can't have access. That was one of the main things. And the risk one was B, nobody said risk, and everybody else said complexity. And that was fun because I loved how you started that. And you started with complexity. You started with all the inner workings of the different Reg Ds, Reg As, all those things. And that just makes it seem complex. So complexity, which is kind of what we went through, the complex part, and access. So Brandon, what I'd like to do is just hit two other really important things. Number one, if somebody invests in this fund, what kind of access can they expect to their money? How would they get their money back in the event of an emergency or they need it? And like, how does that work? Second, let's talk about how simple what it is you do is, because really you do one thing, and I love it. Right on this sheet, it says, keep it simple, Simon. And all you do is you lend on land, you invest in land. So let's hit those two things. So if somebody invests, we'll just use 10 grand because that's the minimum. What is the access of that money once they invest it?
So once you invest, we do have a 12-month minimum that you're required to stay in the fund or offering. And at the end of 12 months, if you find you need your capital back, you just simply submit a redemption request. And depending on the amount of capital that is, you may have your funds back in your account anywhere from 1 week to maybe 60 days. And let me explain that. If you invested $10,000 with us and over the course of the year, you received your quarterly distributions, you got some upside of interest, because all we do is lend, just like Chris is saying. We lend to our strategic partners on land, lot, dirt. It's simple. Those guys take the ground, get it ready, and sell it to the biggest national builders in the country. I mean, currently they're selling to 15 of the top 25 nationals in the country. And they're all in the Southeast, Carolinas, Florida, Georgia, Tennessee, and Texas. But so that's what we do. So you would get, let's say you get X amount of dollars throughout the year in your quarterly distributions. And then at the end of the year, like, I really need my 10 grand back. Well, guess what? Your $10,000 investment is still worth $10,000. You invested $10,000, just like you put it in a bank. It's your money. It's there. We lend it. We earn interest. Here's what happens. One, if we have liquidity in there and you need it, boom, we just do a redemption of your shares. You get $10,000 back. I don't deduct anything that you've earned, and I don't charge any fees for it. Again, I like to keep things simple, right? Now, let's say you have more money in there. You maybe have 50 grand in there, and you're like, I don't want all 50 because I really like what we're doing. I like that we're earning, in the teens every year with Rockstar, but I do need 20 grand. You can do a partial redemption. Same thing. We sell your shares to the next investor coming in, or we cash you out, if there's excess in there at the time. Now, keep in mind, I like to keep the capital working. The idea is that when you invest in with us, that principal investment gets put to work immediately, and it gets put into land deals that can be 9, 12, 18, 24 months before they're turning and being sold off. But it's a business that's well worth it. But you can do a partial redemption. If someone's coming in for a huge redemption, 6 figures, it might take 30 to 60 days. We just have to be prepared for it, plan for it, and again, either the GP can buy the partner or the shares, the next investor coming in, we just sell those shares to that investor, and still no fees. You still keep everything you've earned. I just do things different. Matter of fact, when I set this up with my attorney, he's like, that's not how people do it. I said, I don't care. I don't care how other people do it. I want this to be simple. You know, our investors are the reason we have built this operation and have this success. And people will come to know that as they learn a little bit more about us. We're being labeled as a disruptor in the industry of the paper lot land game. And that pipeline of $1.5 billion of retail ground currently, if you were to rank our partnerships operation, they would be the 14th largest builder in the country for the amount of ground that they own and control. That's huge. All right, so that was the first question on redemption. What was the second question, Chris?
No, it was just what you invest in. So you kind of hit that. So people were saying,
Okay.
you know, it was complex, which I was so happy you started with the complex stuff, the A's, you know, A's and D's, because like a lot of investors are just like, great, but I don't really care about all this stuff. I just want to know, can I invest in it? How much is the minimum? How much can I put in? What's my return? And actually, let's hit that. That's the final thing we'll hit. And then I want to kind of go over it. I want to show the working case of kind of one of the scenarios, but what are the returns for the fund? And there's two components to that. And this is one thing I really liked because it made you very unique.
So when we lend out, we're earning interest. And the way we pay back is based on the amount of closings or notes that are closing in a quarter. We look at what our blended interest earnings is coming in. We pay out what's called a 10% annual preferred return. So for ease of dollars, let's say it's a $100,000 investment. Then every year you'll be receiving 10% annual preferred return. That would be $10,000. And that's paid out in quarterly distributions. So every quarter, you'd be receiving $2,500 interest earned. You're also earning as a K1 limited partner. So there are some tax advantages under this. You can also invest under a self-directed IRA, by the way. So 10% annual preferred. And then our operational cost are about 3% average of the capital that's invested. And that's management fees and operation expenses, legal, banking, staff, registrations, you know, just everything that goes along with running the operation, which in the interest of keeping things simple, when our attorneys asked us to put that together, they said the average offering, you know, elects for anywhere between 5 to 8% total. And I'm like, no, that's not us. Well, that's what you should put in there. I'm like, no, that's not us. I said, I want my investors to really win. I want to see my investors earning somewhere in the mid to upper teens. And that's how we structured this. So let's go back to the basics. 10% annual preferred, that's yours. $100,000 investment, you're going to get a $10,000 preferred return, $2,500 checks every quarter. But if we earned, let's say 20% average interest that quarter, you take for the annual, but we earned it in that quarter based on what we're looking at for the year. 10% is to the investors. 3% is going to operation expenses. You're left with 7%. Investors, limited partners, get 60% of that, which would be 4.6%. So even if we were only earning a 20% average for the whole year, an investor should expect to make about 14.6% interest on their money, which to my knowledge, pretty much beats the stock market.
Yeah, so let me do a visual. So as you were doing that, I was doing a visual. So just folks, imagine this, you know, Rockstar's here. So this is the Reg A, okay, that we just talked about. This is the investment. They pay 10% plus 60% of remaining interest. So they lend money to their partner who basically buys land and gets land ready, okay? When they lend it, that partner pays them interest, averaging, I think I'm going to use your word, about 20% annual. That comes back to the fund. That's how it works. So money goes out, okay, this is the investor's return 10. Money comes back into the fund from who they lent it to, which is at a higher rate. How do banks make money, folks? Banks pay you interest on the money that you put there, and they lend that money out at a higher interest rate than what they pay you, right? But the banks, last time I checked, they're not sharing any of that profit with you, are they? So if a bank pays you 2 and lends it out at 10, is the bank paying you a portion of that 8% spread? Heck no. But here, that's what they're doing. They're lending it out, interest is coming back, and then they're paying you the difference. The 3% is the operational cost. Okay, so 7% is left to split, and that you get set the 60% of. So just a nice little visual of kind of how that flows. Hopefully that was helpful for some of you. I think sometimes just drawing it out while we're explaining it just gives everybody a better insight as to what it actually looks like.
You know, a lot of times when you hear something like a 20% return, you know, everybody you know tells you, oh, that sounds too good to be true. You know, red flags. Nobody can charge 20% interest. Well, to be honest, sometimes I'm charging 25 and 30% APR to my partners. But it's the devil that's in the details, right? You have to understand the math, which Chris is great at talking about. It's the math. I'm going to give you a quick example. This is the easiest way for me to explain it. Let's say my partners found a piece of ground, negotiated with the seller, and they put it under contract. They pay the deposit, they pay all of their, you know, the environmentals, they do their background, they do look for easements, they check with the city. They know they get through what's called risk hurdles, and they know this ground will go to permitting, not a matter of if, just when. Then they'll come to me and they go, hey, Rockstar, we're buying this piece of ground for $4 million. We need $500,000. That'll get us through to full entitlement. We can pay 30% APR on this. That sounds ludicrous. But if they went to a bank, the bank says, no, you got to buy the ground. You got to put 35% down on that. You got to carry this note. Then you can start all the process of environmentals and checks. So the way our partners do this is they never get caught with their pants down. They never get stuck with ground they can't sell. They never get stuck with ground that won't go to permitting in the time frame they're looking for it, right? So $4 million, let's say they borrowed 500 grand at the end of the 12 months, $500,000 at 30% is another 150,000 in interest. They get this thing fully entitled and permitted. They're all in at 4.65 million. I guarantee you they will have that ground sold for 10 million or more. That's a $5.35 million profit on that deal. That 150,000 in interest became less than a 2% interest carry. It's the devil in the details. So that's how we make money. Now I lend anywhere from 15% up to 30% APR. It always depends on the deal. We also have notes and mortgages against ground they own. So under our operation, we have about $77 million in active capital under management lent out against $1.5 billion of retail ground. And their profit margin, even at 40%, let's see, is, you know, $600,000 in profit against $77 million of money borrowed. So my LTV is low. Again, it's just all in the math. This is just not how, it's not normal. Most of the time, people go, well, why don't they go to the bank and get a 6 or 7 or 8% rate? Well, because the bank wants to see all their bank records. They want to see all their LLCs. They want to see all of their registrations, good faith standings. They want to get an appraisal on the ground. It's raw dirt, right? It becomes so much more valuable later. You saw the example. They turned a $4 million project into a $10 million sale in 12 to 18 months. That's huge. But if you go the normal route, guess who wins? The bank. And so we do things different.
Here's 2 good questions for you. So Sam was saying, let's say somebody does a $10,000 minimum because they're just dipping their toe in, they just want to try it. But down the line, they want to increase their position. Does it have to be in $10,000 increments? Okay, that's what I thought. So
$1,000 increments.
Look at that. And then Peter said, and this is a very good one, some funds have had issues with banks, loans, and sales recently and having delays in paying dividends. Has Rockstar had similar issues lately in the terms of late payments? So in other words, you know what's going on with the banks. They're just, you know, not lending. They're slowing everything down. Are you seeing any of that on your end with the dirt?
With us, we've had 6 years of never missing a single quarterly distribution. We're a little delayed on Q4. Normally, we say that we'll have everything out within 2 weeks at the end of a quarter. But this last year, we had redemption requests that were higher than what we expected because of some of these other issues with other real estate deals. Not a big deal, but our accounting got a lot more detailed and complicated and complex, so to speak. So we're making distributions next week. which is roughly, about 7 to 10 days later than we normally like to make them. But this last year was a big accounting. Now, it didn't have anything to do with the operation. It just meant we're getting huge, getting bigger, and, got to allow a little more time to run all that year-end financials and accounting and audits. And it's just big business, right? But no. And in the land game, here's what I can tell you guys. It doesn't matter what you hear on the MSM. When you're working with the biggest builders in the country, they're looking at ground 2 to 3 years out. One of the hottest commodities right now is paper lots. So taking a piece of ground and getting it fully shovel ready and permitted, and if there's not enough of it for the national builders, that's their number one cry for help, is we need more ground ready to build on. We're going into a good administration. Builder sentiment is ecstatic. Yes, the rates are at 7% and everybody's freaking out about 7% mortgage rates. But man, when I was in the mortgage industry in the early 2000s, rates were 7% and nobody shook, batted an eye. It's just what we've got people used to, right?
Right.
So no, builders are doing
two
great.
things, and then I want to move on to the next segment, which is going to be, is it better to invest from a bank account or from your private banking system, the policy? So one question came, well, somebody was asking if you can put the number, or however they contact you, they wanted to set up a call. And the other one is, Peter said, are we first lien holders at all or not because it's a fund? Or let me ask that question for Peter a little different. Are the investors in a first lien position, or is the fund itself in a first lien position and then the investors are investing in the fund?
Yeah, offering. We've got to remember to say that we're an offering. But the offering holds first lien positions. We do have some second lien positions. That's in projects that they're building and have the construction going under construction. Then we'll slip into a second lien position only because I know that the project will get finished. Or we have like mezzanine type finance. If we don't actually own the ground yet, we have an assignment of that contract. But the offering holds positions in ground, lots, and the entity. Sometimes we have actually notes against their entity, a promissory note with confession of judgment, which basically puts us in a really good position. But again, it's a combination of everything. Individual investors, I don't tie you to an individual note or project. And to be honest, it's a little hard to do that when it's a $5 million piece of ground and maybe you invested $20,000. I would have to have a whole lot of you on that, recorded deed and note. And then when it comes time to close it out, we got to ship that out to everybody. Everybody's got to sign. It's a nightmare. So you're investing in an offering. You have shares in an offering. We are tied to and held against significant amount of ground. And guess what? There's not much you can do to screw up the ground. Doesn't matter if fires happen, floods happen, earthquakes happen. Well, earthquake might screw it up a little bit, but hurricanes come through, the ground always dries out and the ground will get built on. And that's one of the reasons I love what we do. I wished I had learned about dirt a lot earlier in my career. We'd be in a whole lot different situation. A lot of profit margin in dirt.
All right, perfect. All right, I'm going to move on to the next segment here. Brandon, if you could go in, there was a bunch of questions that were coming in the chat. If you could maybe just hit on some of those and those. I'm going to continue on. So folks, real quick, I want to ask everybody the question now that you've understood, what it is, what it invests and how it works. If I were to ask that same question, what is the biggest challenge when it comes to understanding investments like this? A, access, which is 12 months. B, risk, or C, complexity. Which one would you put? A, B, or C? Put that in the chat. Love to hear kind of now that you've learned. And this is what I always say, invest in things that you know, you like, and you understand. Breaking news, this just in. Are you sick of having your money lying around not doing anything? Well, we've got the solution for you, privatemoneyclub.com. Back to you, Chris. You're at the early stage of starting to know, like, and understand this kind of an investment, this fund. So that's the first step. That's what I do when I do my due diligence. I dive deep into the members. I do background checks, which their auditor, they're required to do that background check. So it's kind of like the SEC already does that for you and takes a lot of the guesswork out. So really you could just focus on what it is they do. Is it in line with your risk tolerances? Is it something you know, like, and understand, or want to know, like, and understand it? Now we come to the next part of this whole training, and this is how do I invest into this? What is the best way? Well, you could do self-directed IRA or self-directed Roth IRA or self-directed 401ks, no problem. You could invest with cash, which we're going to look at, or you could change one thing and add one step and invest using your specially designed and engineered whole life. So instead of keeping savings in a savings account, you put it into this specially designed whole life. You then take a loan from the insurance company, and their rate right now, I don't know, let's just say 5.5 is an average. It's different depending on the company, but some are lower, some are higher. So we'll call it 5.5. That loan that you take is actually meaning that whatever money you have in here, so if you had 10K in the policy and you took 10K out to invest in the fund, we'll just say the Reg A offering, okay? If you did that, you still have 10K earning interest and dividends, which the interest inside the policy is guaranteed interest, plus you get paid dividends, and the interest and dividends are tax-free, okay? So that's the policy. You take that money out. Yes, we've got a cost for that. So what we're going to look at today is we're going to look at where is the break-even point from what your policy's earning to what you're paying, right? This is how banks work. Banks pay you to lend it out at more than 2, right? So if the insurance company, we'll just use 6 because that's a nice round average. If the insurance company were to pay you 6 dividend crediting rate and charge you 5.5, that'd be a spread. So we'll call that spread number 1. And the second spread you could look at is over here. If you know the Reg A offering pays 10 and you know that it's going to cost you 5.5, this would be spread number 2. But you can chop it up any way you want. If you take it over on this side, the policy paying you versus what their cost is, then that's there. Then you're netting the 10. If you do it here, then you're just netting what the policy makes. Doesn't matter how you do it. And then we're going to show you the impact of taking the interest and that 60% of the excess and recycling and recapturing it. So this essentially is a drawing showing that. Now, I'm going to share my screen and we're going to rock and roll through this and we're going to get to the topic which I liked, Craig put this together for me and we worked pretty hard on this one. This was a really interesting case study, building your financial base. And I love the name of that because that's what we're doing. We're deciding if we're going to invest money, how do we build the base of what we're going to invest from? Because this is the one thing everybody needs to understand. And I'm going to simplify it. You don't have to decide whether you put money into the policy or you put money into, this Reg A offering. It doesn't have to be a decision of which one you would do. Because if it was a decision, you would always choose probably the Reg A because it pays 10%. The policy doesn't pay you 10%. So if people were looking at it, they say, oh yeah, I want the best return. And you would do the same for your bank account. You'd say, okay, if I'm making 2 in the bank account and I could make 10 over here, as long as it fits my risk tolerance, I want the 10. But see, with the policy, you don't have to decide whether it's this or that, because it is this and that. You're going to earn in the policy and you're going to earn from the fund. So we're going to basically combine those. So the impact of changing where your money goes first makes a huge difference. Now, again, disclaimer. So all opinions that we're going over here are just informational purposes, just educational. We're not giving investment advice, not giving financial decisions to you. Consult with your financial, legal, and tax advice and attorneys and all that good stuff. All right, enough of that. What we did is we looked at, because I know everybody's so hyped up on what they're making in their checking and savings, mostly savings accounts now, because there are high yielding savings accounts paying 4.5%. But how many of you think that that's a long-standing thing? How many of you think that's what banks are going to continue to pay next year, the year after, the year after? You'd be really setting yourself up for failure if that's what you thought. Because when we go to the average and we look at a 10-year average, which I believe is what we did, actually 14-year average from 10 to 14, this was your average, 0.42. And that's probably realistic, about 0.5%. So what I'm going to use this average. Now we could dial this in and we did. I think we ran examples at 4, we ran examples at 2, we ran them at 1. All of it changes the numbers a little bit, but this is realistic. Okay, so if that was the thing, now what if we changed where the money you're going to invest went first? Now, what that means is putting it into the policy like I mentioned. So this right here is a policy that I set up for myself and my family in 2020. Okay, it was a high early cash value policy like we build. So it was designed and engineered to have high early cash value that could be used immediately in the first 30 days. Every one of you that have worked with us or will work with us in the future for setting up your policies and implementing the infinite banking concept, this is how we're going to build your policy. No different. Okay, so $30,000 was the amount I put into the policy. I fund this policy monthly. So I make, or I'm sorry, quarterly for this one, but it doesn't matter. You could do it monthly savings, you could do quarterly, semi-annually, or annually. I happen to fund this one quarterly, and then here's the breakdown of how the money gets put to work. None of that's important. This is kind of like where you're like, wow, too much info. Perfect. All you want to know, how does that look? How does it earn? Like, what does that look like? Great. So the first year, if I put 30 in, I had access to 27,534. In return for that difference, okay, so right here, this is the difference, $2,466 is the difference between what I put in and what I have, okay? That's roughly about let's say about 92%, give or take, I'm rounding up, is what I had access to. But for that difference, I have a $765,367 death benefit. To me, I can't even go out and find a term policy at my age of a ripe 47 years old. I can't even buy a term policy for $765,000 for $2,066 a year. Go out there and try to find a term policy that cheap. But Dave Ramsey will tell you all day long that whole life is the worst place you can put your money. You should buy term and invest the difference. We did a whole white paper showing you that that is all one big farce. If you want the white paper, in the comments, put white paper, and then Craig, if you could just respond to them on how they can get that. But here we go. The second year, now it's going to drop a little bit, 29.9. Okay, so whatever, we'll call it 30 grand. How much money did I have access to that year? 29,540. So now, again, I had a negative draw on my money of roughly 2,800. But again, now I have a death benefit of $829,000, and so on and so forth. But you can see here, by this year here, by the third year, and this is pretty common without a dump in the third year, I put 29.9 in, and now I can start taking more than 29.9. And every year from this point on, I'm going to make a spread. I'm going to make more, not a spread, but I'm going to make a return on my money year over year. And that's reflected here. So that third year, I made 3.33% net of all cost of insurance, net of commissions, net of policy service fees. That is the amount I made that year by the math. The next year I make 6.07. The next year I make 10. And then 6, it drops here. This policy design is weird. Usually they just show a steady return. 12%, 17, 23. Those are the numbers from my exact policy. So the reason I showed this is what we're going to use. So let's move on. This is our software that we've created. And what this is going to do is this is going to show the net benefit. But you know what? I'm going to move on, and we're just going to come here to the comparison. So the whole idea is, if I, in the fourth year, because I'm going to start in the fourth year because my policy is now 4 years old, if I invested $30,000 from my policy into Rockstar, if I only earned 10%, so there was no extra to split, which he told you there has been every year in existence between 14 and 16%, but I'm only using 10%. Would I be better off using a savings account to invest that's earning 0.42%, or would I be better off doing it from my policy, taking a loan from the policy and then recapturing the money? So we baked all the numbers in. We baked in the loan interest from the insurance company, which I believe, Craig, what was the loan interest we used? Was it 5.5%, I believe it was in Mass. So we used 5% in the loan interest rate. And here's how the numbers shape out. So if we did it from a savings account versus the policy, we made an extra $2,592 in the first year. But the savings account didn't actually make $2,592 more. Here's the reason. I'm not netting out the taxes. I'm not a CPA. I don't want to get into tax, advice, but remember the policy grows tax free. So when you make this money in your savings account, this 0.42%, at the end of the year, they're going to send you a 1099 for the interest. So I'm not factoring taxes out of this. So this difference is actually less when you net out the taxes. But nonetheless, if it was a difference of $2,592, but I get a death benefit of $765 in my policy versus no death benefit in the savings account, if I bypass probate in the policy, but I don't bypass probate in the savings, is that worth $2,592? That's a question all of you will have to answer for yourself. Moving on, you can look at these numbers, and the negative means this is how much more you made in the savings account earning 0.42% than you made in the policy. But the policy at that point in time, right here, that would be year 7, the policy had a $1.1 million death benefit. But yes, I had $2,843 less money I made. That will be the very last year you ever make less with the policy. And the reason for this is simple mathematics. Okay, number one, in the policy, we started with less money. We started with $30,000 in the bank account, and we invested $30,000 with Rockstar. And in the policy, we basically don't have access to all of the money, so we literally wouldn't have all the money to use. As you can see there, account balance $27,534. Now again, we did the investment in the 4th year of a policy, but I'm just trying to call that out. Secondarily, the policy has a cost of insurance for this death benefit. The policy has a commission, which is 90% less in this particular design than what you would, or what another agent or advisor would make if they sold you a regular whole life. So it's a 90% reduction in commissions to design a policy this way, and tax-free growth. So take a look down here now. In the 8th year, that's where we cross over. Now the policy has a better return than the savings account does. So right here, our account balance is $261,751 in the policy's cash value. Your bank account balance is $261,424. So what this account balance is, it's comparing the difference. Remember that all of the interest is being put back into both. So if it's a savings account, we invested 30 grand in Rockstar Reg A opportunity, and then we took the money and we put it back into the savings. In the policy, we took the loan out, we invested the loan the same way, took the interest that we're earning, 10%, put it back into the policy as a loan repayment. Dollar for dollar, everything's the same. But here in the 8th year, we have more money in the policy than we do in the savings account. And the next year, that is just going to keep getting bigger and bigger. But just look at the returns. Here's your cumulative return. Remember, we were losing for the first 4 years in the policy. We were losing, but we now are gaining and picking up steam, and you can see that right over here. So by the 15th year, your cumulative return in doing this program, using your own private banking system, is 35.24, where over here, your cumulative return, all baked in, is 14.67 in the savings. By the math, you made $73,841 more in a 15-year span. In a 10-year span, you made $11,898 more in the policy, plus your family's protected over $1 million. Okay, so there's the death benefit. Plus, this grew tax-free. Your bank account did not grow tax-free. So your bank account, when netting out the interest that you earned on your bank account, which is that 0.42%, you had to pay tax on that. I did not factor that in. So your actual returns in real life would be more in the policy than what we're showing, or I should say not more in the policy, be less in the savings account due to taxes. But now what I want to do is I want to kind of show you our software, and I want to show you how this works. And I think this will be a really cool exercise. So I'm just going to go year 1, where we make the investment. So first off, we take 30 grand into the policy, no money went out. Okay, because we just started the policy, first year. The second year, we did the same thing, 29.9. We did not take a loan. There's your math. Okay, so cumulative return is negative 4.71, but we got a death benefit. Third year, we do the same thing. We're not investing in Rockstar yet because we just haven't done it, because I'm just showing you real life. We lost 2%, but we got an $893,000 death benefit. But the 4th year, what we're going to do is we're going to take a loan for 30 grand and we're going to make that investment. Okay. Then we're going to take the gains, which would be 10% of 30,000, about 3 grand. We're going to run that back into the segregated account, but we're then going to make a loan repayment, a principal repayment to the policy for 3 grand. So now everybody sees what's happening. Now I want to just start showing you the math. In the 4th year, we made a cumulative return on this of 1.241. The 5th year, we do the same thing. We have a loan balance of 28.5, because remember, we've been paying the loan down with the interest from Rockstar. And now we're not going to make any more investments. All we're going to do each year is we're going to take the $3,000 in interest, only the 10%, and we're going to just roll it back into the policy. I want you to pay attention to the returns. Cumulative, you made a 4.137. And as we keep going, Year 6, we're doing the same thing over year, but your return is going to keep climbing. So is your death benefit. So is your cash value. And as we keep going here, I know it's monotonous, but I really just trying to get you to this part right here, 7.319, 8 years, 9.382, and 9 years. So 9 years, now our cumulative return is 11.676 return. In the bank account, what would your cumulative return have been? Well, it wouldn't have been this. And this is where we start running away and it starts getting more and more. 10 years, 14, 18, 22%. So the only reason this can happen, folks, is because all of the money that you've put into the policy, all of your cash value, this entire 12-year period never stopped earning uninterrupted compounding interest, guaranteed interest and dividends. Those interest and dividends you've been paid, which were growing tax-free and growing uninterrupted, are the reason why your returns can be this way. This cannot happen in a bank account because the initial $30,000 in the bank account is in Rockstar and it's working there once. In this program, your money is working twice for you, which is how you're able to earn cumulative returns. And listen, as we keep going, year 13, look at the return jumps. Like now you're really starting to see the impact of uninterrupted compounding interest. And this is really the big differentiator is $30,000. In this, 30 grand has been working for you now for 13 years. In the bank account, that 30 grand is in the Reg A offering making 10%, but it's only making 10% once. It's not making 10% plus the bank is paying you interest on that 30 grand. The 30 grand is in the fund. So it cannot work twice. Hopefully everybody's picking that up. And we're doing this by the math because I want you to start seeing like the impact and the benefit of doing this through the policy versus doing this the plain old Jane way of investing from a bank account. 30%. And look, let's just say in the 14th year, something happened and you passed away. Your family gets a check tax-free for $1.362 million. And that's the impact. And if we hit the 15th year, 35.236. 35.236% cumulative return for doing this. So when and also if you've noticed, the loan balance that you took from the insurance company is now $86.90 because we've been using interest to repay the insurance company, which all that's doing is just by repaying the insurance company, you're getting full liquidity. So every time you put 3 grand back into the policy, just so you know, you have 3 grand. So that was all accounted for if you were following that. That $3,000 that you're putting back in is immediately available. It's not like a loan from a line of credit or anything else. That money was all available, but by you paying that loan down, the insurance company is now only charging you 5% on $86.90 because so it's a lot less interest from an APR standpoint that you've been paying out to them. So that's the whole program. This is kind of what we've really been doing behind the scenes. We've been really breaking the math down. We get asked all the time, what's the best way to invest in something? And, we always would say, oh, the policy probably would be the best way. But now we can mathematically prove it because of software we've created, software that Craig has created. And that software is about to take a major leap forward and it's going to serve all of you very well. But I hope everybody who's watching in that comparison, you just see the economic benefit of changing where the money goes first and following the exact same protocols you would with a bank account.
So if anybody has any questions, throw those in the Q&A. We'll cover all those, whether it's dealing with the Reg A, Reg D funds, money movement, anything about infinite banking. But does one need a medical physical? Do you send someone to do this?
Yes. So there is a nurse. So when you start the policy, a nurse is going to come out. They're going to do a blood draw. You're going to pee in a cup, and they're going to ask you some medical questions. The nurse is usually in and out in 15 minutes. I've done this 14 times. So, but yes, it's a full underwriting that you have to go through to get the policy. Great question.
This person has $50,000 in a high yield savings account paying 4.3% APR. If they were to move that and dump it into a specially designed whole life policy, how much would they be making yearly? And it's compounded, correct?
You're talking 50. I did 30. So, I'll reshare my screen. I don't have the ability to just go in and rechange my entire presentation because you want to see it on 50, but I can certainly come in and show you this, which should kind of give you an idea of the 30,000. So again, you're comparing a bank account and you're comparing a bank account in today's interest. I promise you one thing. Next year, you're going to be making less on that exact same savings account than 4.3. As the Fed drops interest rates, which they have clearly showed you their indication of continuing to drop interest rates, it's been very clear. Jerome Powell and the Fed has been very clear about their direction on interest rates until they get inflation under control. And inflation went up, then it came down a little, but we're still at about, I think, 3.2 right now, not 2% target. So they're going to keep dropping interest rates. That's going to happen. Every time they drop interest rates, guess what your bank account does? Reduces the amount they pay you. And it makes perfect sense. If you're getting 4.3 in a bank account, but yet the bank is taking the money you give them in your bank account and buying treasury bills from the United States government, okay, they're buying bonds, IOUs, and if those bonds are paying them less, then they got to pay you less. It's just how it works. So it would be a very unfair assumption to run any kind of an analysis showing 4.3% moving forward from a bank account. I would be literally lying to you. I would be showing you math that will never happen. It just won't. So I'm just being clear. But here's the math on the policy. If you did 30 grand, these were the returns here, cash on cash returns. And here was how much cash value you would have. Plus, you'd have a death benefit. Now, there are going to be some folks that come on and some folks we meet that say, hey, I don't care about the death benefit. That is hard for me to hear. And I would probably say then you're probably not a good fit to work with us, because most of you, if you said you don't care about the death benefit and you have a family, we have a real ethics problem between my viewpoint and yours and not what our company stands for. We believe that families truly care about their family, want to leave their family in a better place, and so on and so forth. So the death benefit should be important to everyone that has somebody they care about. But there are some people that say, nope, they're on their own. When I'm gone, I'm taking it all with me, and they can be on their own. So then the death benefit wouldn't be a factor. So then you'd really just say, screw the death benefit. Is this right here, is this math or is the projected cash value in line with what my expectations are? And if you want to run what your bank account's going to earn, just run a compounding calculator at your 4.3%. Great. And you'll probably never do this, but you're setting yourself up for failure is all I'm trying to say. Sorry, I'm being a little bit, I don't know how you articulate what I just said. I guess I'm being direct, which I tend to be very direct, but I'm being a realist and I'm trying to get people to not set themselves up for failure. And if you're using the interest rates that you're getting on a bank account as your kind of main guiding light, then you're setting yourself up for failure, because those interest rates will be gone in the future, or shouldn't say gone, significantly lower. That was a long-winded answer. Sorry about that.
No, it's all good. Some people asking, what's the minimum investment, or like what, can I get in for less, or, do I have to do this for 30,000? Okay. So first off, maybe investing, today isn't necessarily where you need to be. Maybe you have some debt that you need to pay down first. And so this is all, you kind of jumped into the wealth webinar today. We're talking investing and growing wealth and using this policy to flow to get into these investments. But majority of our clients start with paying down debt first or using this for something else. And so just keep in mind, like what we're talking about today, you might not be necessarily ready for it right now, but would you agree that it's important to be in these types of rooms? I can tell you one thing myself over the last 15 years, I purposely will try and put myself into various groups or masterminds or take courses where I know I'm going to be the dumbest person in the room. Why? Because I want to surround myself with people that know more than I do, that are going to teach me and rub off on me and are going to be there for me when I need them. And that's exactly what this might be for some of you on here right now. Well, when it comes to these policies, remember, this is very flexible. We can start with a very small amount, a very large amount. We can use this to pay down debt. We can use it for major purchases. We can use it to recapture for things like for every car you'll ever buy, drive, and own, getting back every single dollar. And we can use it for growing wealth, whether that's investing in a fund like Rockstar Capital has, whether that's something through Private Money Club, whether that's our own personal investments through purchasing real estate or rental properties or flips, or even taking the money and putting it into the stock market or more traditional investments. But there's a lot of different things that we can do with this. It's the overall strategy we kind of wanted to talk about today. Does that make sense, Chris?
It makes perfect sense.
Okay, cool. So what I'm going to do is I'm going to put a link over in the chat box. And if anybody wants to schedule a call, we have a team, what we call our money mentors, and they're personally trained by Chris, by myself, by our team. They're all very experienced with the infinite banking concept. They all invest in things like Rockstar Capital themselves. They're all experts at solving your money problem, whether that is debt, whether it's wealth growth, whether it's family planning, whether it's kids policies and setting up a family banking system. We're experts at this, our money mentors. So I'll put a link over in the chat box. Schedule a call, chat with us. Let's talk. The one thing I would ask is to watch our full IBC 90-minute training video first prior to the call. And that's just so the call is a lot more efficient. That's going to allow you to be able to have some questions written down, start thinking about your personal situation. So when you do get on that call with a money mentor, you can utilize that 45 to 60 minutes to its maximum. And trust me, you're going to want to do that. You know, we've been recommended by outside consultants to charge up to $250 per hour for these strategy calls. Like, that's how valuable. Now, they're free. That's because that's our business model. Chris decided years ago, we're always going to give our best stuff away for free. It's why we do this wealth webinar every single Wednesday with different experts, different topics, different opportunities, and different education around investing in the infinite banking concept. But at the end of the day, you know, we're here for you. And so take advantage of this stuff, guys. It's a beautiful thing. So I just wanted to share that, and I'll put some links over in the chat box right now.
Awesome. And I want to hit one other thing too. I want to just come back to something now that you all saw it. I know, you know, I beat you up with a lot of numbers, but this is the one that really was the one that rang home to me, is this comparison chart, investing from a savings and investing from a whole life. You know, when we look at this difference, you know, this 2,000, 3,000, 2,000, 5,000, when we look at this, you know, and that's for 7 years. Okay. 7 years is what you literally would make more in the savings than you would in the policy. I just have like such a hard time when I hear people say invest or buy term and invest the difference, because literally that's kind of what we're showing you here. We're showing you the buy term, invest the difference strategy, which would be on the left side, but that doesn't include the term cost. Then you'd have to say, okay, I'm 47 years old. You'd have to put your age in there. I'm 30, I'm 50, I'm 60. And then go to the lowest cost term provider there is out there, because term insurance is a commodity. Find the lowest cost term for, let's do the lowest amount, $765,000. I would bet, unless you're 20 years old, and I even think then it would be hard, I would be hard pressed to say that any of you could find the cheapest term policy anywhere for less than that, or for anywhere even close to this. For the 2,592, the 3,000, you know, I know it's a varying number, but if we were to average that out, let's just say it averages out at $3,000, you probably can't get a term policy for 765 anywhere close to that. And I guarantee you this, you'd never be able to find a term policy that has a term of 7 years that you pay, and then in the 8th year, you no longer have to pay, but you still keep the death benefit. In a term policy, when you stop paying, the coverage is gone. So when you really look at the economics behind this, and you really kind of go up against the world, is what I got to kind of say, but we'll call it the gurus of the United States, the advisors of the United States, the know-it-alls of the United States that always say, oh, why would you ever put money in a whole life? Just buy term and invest the difference, and you're going to be far better off. Those whole life policies, those are a scam. And then you look at the mathematics, which I'm showing you here. It's kind of like so many things in the last 4 years, where you kind of got to just sit there and you say, you know, what I've been taught my whole life is not really the truth, because this proves it. Like, and I can't show it any better than using my exact policy to prove that point. So this was like a big aha for me when we did that. It really was. The other thing I wanted to say here is I want to go back to the takeaways of what you all learned on this, because it's really important that every one of you kind of know what you just took away from this. First off, we went in, Brandon went into the difference between a Reg A and a Reg D. And I think that will serve you well moving forward, because now you're more sophisticated in understanding what kind of investments there are outside the realm of the advisory world, or the financial advisor world. Number two, you learned how funds work with regular dollars versus the IBC method, okay, using the policy and the infinite banking concept. So you saw that direct comparison. And the last thing, due diligence and the leveraging of IBC to maximize returns and just economic benefits. So the due diligence is really important. I'm really excited to hear that some of you are going to book a call with Rockstar. He just put the information in there again, so you could book that call. get on the phone with Brandon and his team, learn about the fund. If it works for what you're trying to do, but I think here's the best part about it, is you can invest small amounts, like 10 grand. You know, like you could take your self-directed IRA and you could put 10 grand into this to try it out. But I think that's the best part. There's very few things we find in the private investing world, which is the world we kind of live in, the alternative world, that you can get in the game at 10,000. As you mostly know, if you've been around this campfire, most of them start at 50 and the majority of them are 100,000 or more. Okay, that's what it takes to get in. And that limits so many people from entering this world because like, oh, I can't play in that space. I want to, and I'll get there, but I can't do that today. We're here now. You've got this lower barrier of entry to getting into it. Again, do your own due diligence on all of that. But I just really think the beauty of these strategies is really just understanding the rules of the game. And that's what we wanted to do today, is explain the rules of the game. And I think Brandon did a phenomenal job breaking that down. And then, you know, we went from most people saying all the complexity to at the end, most people are like, that wasn't complex at all, because you just got what they're investing in. And everybody can walk outside your door and you're standing on dirt. There it is. That building you're in, the building across the street, the building over here, that all started with dirt. So if you understand that, then you understand what you're investing in. And that is pretty much the majority of your due diligence that you got to do for yourself. The final thing I want to do is Shauna has been giving me these final closing things. And I think this one is great. So if I may read what Shauna said here,
Hey, Chris,
she said this. Yeah, go ahead, Stephen.
before you do that, just real fast, I also just everybody that's on, I want to kind of reward you guys each week different ways for being on these webinars and whatnot. So, you know, and back to Shauna, she seems to run the show here. So, you know, I was talking with Shauna about how to do this. And so, like I mentioned, you know, one of the things that's allowed me to meet people like Chris Naugle and Brandon and you know, and people around our network is by attending events and masterminds. And, you know, we hold different events throughout the year. So we have an event coming up in May. It's actually May 8th and 9th in Dallas, Texas. It's called the Private Money Club Money Tank. We've done these for the last couple of years, but what we're doing this year is we're changing it a little bit. And it's going to be probably one of the most valuable events you could attend this year in 2025. So what I want to do, Chris, just as like kind of a reward for anyone that's on right now, what we decided, we're going to up the ticket price for the money tanks this year. But for everyone on here, I want to give you guys an early bird discount offer. So we've never done this before. We're not going to publicly advertise a discount anywhere. Our sales team's not going to offer discounts. We're just going to do it in little scenarios here and there to reward people for taking action and being around the campfire. So if you guys like the idea of what Brandon presented today, of meeting more people like him, opportunities, how all this works, and surrounding yourself with the right people, email Shauna Decker. So I'm going to put in the email in the chat box. It's Shauna@privatemoneyclub.com. Send her an email. And what we're going to do is we're going to give you an early bird discount. We've never done this before. An early bird discount so you can lock in your ticket for Money Tank May 8th and 9th in Dallas, Texas. So hopefully that's all right, Chris. Just wanted to do kind of like a little special at the end here for everyone, and I'll let you take it home from there. So thank you, guys.
That's great. I mean, we have a blast at Money Tanks, and this one's going to be even better than the prior ones. Every event just seems to get better. So here is Shauna's final quote that I wanted to read to you, or she calls it a powerful statement. The smartest investors don't just follow the crowd. They create their own opportunities. With IBC, you don't just invest, you take control. Let's make your money work as hard as you do. Well said. So with that being said, Brandon, I want to give a big shout out to you and your team. Thanks for everything. Thanks for making the process of me investing our foundation's money as simple as it was and straightforward. The platform, the portal, my CFO and bookkeeper loves it because she can log on there and see everything. So big shout out to you and what you've done, and just keep doing it, because I'm now in it to win it. And with
Same
that,
here.
yeah, with that being said, any of you, if you're really interested, just get a hold of his team or go to privatemoneyclub.com and you can get his contact information right there. There's a little banner that will be up on there soon. And the final thing, just thank all of you for making this webinar amazing. I love seeing the numbers every week climb. I love seeing, most importantly, I love seeing all the new faces, but I also always love the old faces, our legacy folks that are in the community, have been around the campfire forever. So big shout out to all of you. With that being said, folks, that's a wrap for this wealth webinar, and we will be back this afternoon later at 4:30 p.m. Eastern time for the Ask Me Anything happy hour, where you can literally just bombard the entire team with whatever questions you have. I noticed a couple of people said some of this is over my head, but or I have questions. That's where you go. So if you want to join us there, just go to my YouTube channel at the Chris Naugle, subscribe and click the little bell, and it'll notify you the second we go live. With that, thanks everybody. We'll see you on the next one. All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.